The following is a presentation of BizVisor. We have 33 years of financial analysis experience. Here are our offices at 1087 Stone Ridge in Bozeman, Montana. We get asked the question a lot, how do you finance a business? Let's talk about that a little. Okay, so I get asked this question a lot. How much capital do you need to buy a business? Well, this is going to depend upon, the assets of the business, has used, or what assets can be used to secure a loan. Banks want hard assets and like equipment and real estate as collateral. Most won't use inventory for good reason. I mean, it turns over and it's not always there. What you use to secure has to still be there. You'll need a good 20% down as a rule of thumb, and more is always better because it gives you negotiating leverage. Of course, owners are always a source of financing, but they tend to ask for higher interest rates, sometimes shorter terms. I've seen owners at 3 to 5 years at 8%. Well, great. That's all fine and good, but I can run over here to the SBA right now and get a loan for 6% for 7 years, which perfectly matches the depreciation schedule for the equipment that I'm buying. So, so as a rule of thumb, the greater the down payment, the greater the level of negotiation power that you have on interest rates and terms. So, next question is, how is a business purchase financed? Your best bet, assuming you have the assets, will be to partially back the loan and the cash to make a reasonably significant down payment is the SBA. In the Small Business Administration, there are 2 loan programs we'll probably primarily focus on. One is the SBA 7A program, and the 7A program is a general small business loan. There's also another program that's called the CDC 504 loan program for real estate and equipment. Most of the SBA programs will have a maximum term of roughly 7 years, which matches up with equipment and personal property depreciation schedules allowed by the Internal Revenue. However, the CDC 504 program can be negotiated for maturity terms of 10 to 20 years. So this is for when you're purchasing real estate plus equipment. You need a longer amortization schedule because the real estate obviously is going to be a more significant investment up front. And the assets typically that back the purchase that are collateralized by the bank are the real estate and the equipment itself. On most SBA loans, you will find yourself working with the same bank that you currently bank with. And that's not a bad thing. Obviously, you've got a relationship with that bank, but unless your bank is not an SBA approved lender, and that can become a problem. But there are several even preferred SBA lenders right here in our local market, and we're not that big a market, so I'm pretty sure we can get it done regardless of the market that you operate in.